At the moment, Spanish 10-year bond yields climbing to a Euro-era record of 7.368%. We've got Italian 10 years soaring as well. Look, we seem to, as Michael said, sort of move beyond, at least for a short time, these fears of Europe, but back with a bang.
Absolutely. Well, last week was a fantastic week for the market, and back last week we were still seeing the Spanish 10-year yields above that 7% mark. But we have seen Spain once again in focus. Reports that Valencia, a region in Spain, has asked for a bailout from the central Spanish government, and also Bloomberg reporting that perhaps 6 regions could be looking at a bailout as well. We've seen Draghi saying that the ECB will have limited extra involvement, and that's really sent jitters through the euro as well as through markets. We've seen risk assets sold off across the board. Copper prices were down by about 2.5%. We've seen the rebar prices, the iron ore prices also trading down lower. So not surprising to see that most of the pain was felt by the resource space. We saw BHP down by more than 2%. We saw Rio Tinto losing about 3.5%, but it was Fortescue which saw some huge losses, down by a massive 7.1% today. Every sector traded lower. The only exception was Staples, and that was because of Woolworths' strong quarterly sales report coming out, and Woolworths ending the day up by 1%. We also saw some pretty big moves on the market. Alesco, which was in positive territory for most of the day after the sweetened offer from Dulux, actually ended the day down by 0.5%. So that tells you a lot about market sentiment when a takeover offer has been raised. The share price up most of the day and then finishing down. And Intrepid Mines, an absolutely horrific session. Its joint partner in Indonesia has halted operations at that particular project, and that stock off by 55% in just one session. So a lot of pain on the market today.
Look, there is a lot of value. Things are looking cheap at the moment. You go, yes, they are. But the way the market is, tomorrow or next month, they could be even cheaper.
Absolutely. And I've just been reading long-term capital management again, and it's one of the probably the smartest group of people that came together to put a fund together. It was run by trader John Merriweather, and it had Nobel Prize winners in there, and they amassed a huge fortune, $6.4 billion, put it into their models, and at the end of the day they went belly up, and central banks around the world had to step in. And I guess the lesson from that is that their models worked in a normal environment, but when the push came to shove, when there was a normal environment, what they found was that the models really didn't work because all assets moved together in a crisis. And when you do see crisis, the problem is correlations do tend to move together. We've seen this risk-on, risk-off environment now for 4 years, which makes it very difficult for stock pickers. And we've seen that kind of commentary come through from stock pickers like Platinum Asset Management, that it is a very difficult market because when assets move together, well, how do you outperform the market when everything is either dropping together or moving up together? So it is a very difficult environment. While valuations are looking relatively cheap, there has been a reason behind that as well. Often we just focus on overseas, the US and China and the US, but here in Australia as well, we've seen a number of quite weak sectors. And if we have a look at earnings season for FY12, the consensus earnings growth is just 0.4%, so predicting pretty flat earnings growth. And if you have a look at the material space, it's likely to be the worst in terms of earnings growth, with a negative 23% FY12 results. So if you have a look at the sector by sector performance in the last 52 weeks, well, there is some logic to it because we have seen certain sectors of the Australian market coming under pressure in terms of earnings growth.
And Julia, in terms of our upcoming earnings season, I mean, do you see that as providing a catalyst one way or the other for our market? We saw from Woolworths today that if you can beat expectations, the market will love you. However, we've also seen that if you undershoot, you're in for some trouble.
The key this earnings season is going to be the commentary coming out, because FY13 earnings growth is still at 11.5%, so that looks extremely high given that we've only seen pretty flat earnings growth expectations for FY12. So we're going to be watching that closely. Some of the highlights are likely to come through and flow through from the telecom as well as the insurance sectors. We're expecting to see telecom earnings up by 10% for the year, so that explains a lot of the great performance that we have seen from that telecom space, as well as it being a risk-off environment and better for those defensive assets. But also insurance likely to grow by around about 30%, so that bodes well for the insurers like Insurance Australia Group, Suncorp, Metway. And this earnings season is going to be important because not a lot of money managers like to put on big bets just before earnings season. Why would you buy a company when in a few weeks' time you could see news which will move the share price significantly? So after earnings season, we are likely to see a reweighting of portfolios and hopefully some better volumes coming through for the market. So as Michael mentioned, it is the Northern Hemisphere summer. We see summer holidays, less volumes coming through from the US as well as from Europe, but also it's earnings season. So traditionally this is a bit of a quiet lull in the market, and hopefully we'll see an uptick in volumes after earnings season.